Hey everybody, how are we doing? Happy New Year. Welcome back to another ITPM webinar. Let's get a test here in the corner, please, of the Q&A area. So you should see on the right-hand side of your screen a Q&A area. Please put in your location so we know that we can be heard around the world. Okay, we're looking good. Americas, Europe, Asia Pacific. Good turnout. Fantastic. Okay, guys, so we're still waiting for people to come in. As you can imagine, we're only 1 minute into a 2-hour webinar. Probably situation today is going to be a 50-minute to 1-hour webinar followed by a Q&A session. But we've brought on a little surprise for you to this webinar. You may or may not recognize the face on the screen sitting next to me. This is Phil Klein from Austria, who is a student of ITPM, former student of ITPM, who has now recently been hired as a junior trading mentor, working with the senior trading mentors based on his incredible track record of the last 2 years since I mentored him on the Thailand mentoring program. And Phil is going to help me today go through today's webinar and give you some amazing information. So who remembers Phil from a previous webinar that we did a couple of years ago? So we did a webinar called Meet Phil and Gunter. It's available on YouTube. Has anybody seen it?
Hey guys.
You can answer in the Q&A area. Let's get a sense of how many people in the group have seen it. Okay, if you haven't seen it, I would definitely urge you after this or in the next week or two to go and watch it. Free video online. It's a webinar that we did a couple of years ago after I mentored Phil. And Phil, remind me of the statistics again of your mentoring program and then afterwards.
So during the mentoring, I made like 60%, and overall for the year, I think 60% as well. But yeah, after the mentoring, it went really, really well for me. So yeah, I will show you some of my statistics today, and also some of my trades here.
Yeah. So basically, during the 14-week period where I was mentoring Phil on the Thailand program in 2022, he started with about 102 grand and made like around 60 grand, right? So he was up about 60%, right? Then the period after, for the rest of the year, he was flattish. And then afterwards, he really took off. So 2023 and 2024, we'll give you a little taster now. In total, he's made 400% in 2 years, okay? And the topic we're covering today, the reason I've got Phil on is because it's completely relevant to the topic that we're discussing today. And you're going to see absolutely for real, what this looks like when a real guy like Phil is trading with his money and implements the ITPM process and focuses a lot on compounding as a trader. And it's going to become really obvious to you that Phil, within 2 years, has become a master of compounding as a trader. So guys, I'm going to share my screen now. We're going to kick this off. I'm going to need you to let me know that you can see this on the screen. You should be able to see that now.
Yes, we see it.
Okay. Fantastic. Looks like we can be seen around the world. Okay, so welcome guys. This is the topic we're covering today, how to master compounding as a trader. And you're probably thinking to yourself, well, do traders really compound? Yes, absolutely we do. We're going to go through it in the next 50 minutes or so, 50, 60 minutes. But first, while we're still waiting for people to come in, like Phil, if you want to join the Thailand mentoring program, you can just about squeeze in for 2025, but you have to be very quick if you're new to ITPM, because you need about 2 to 3 months to finish your online programs if you've got a full-time job, and then show up in Thailand with your money in your trading account, and then we trade from May till the end of July. But essentially, the 2025 program is pretty much sold out. Okay, we've actually got 28 places already booked, and I think I'm speaking to 2 guys next week who are going to take some of the final places. So if you really, 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 really want to squeeze yourself in to the Thailand program this year, you've got to move very, very quick. Okay, if not, you're going to have to wait another year to the 2026 program. We are soft launching it, which means we're mentioning it on webinars, but it hasn't gone fully public yet, where we start putting it on YouTube and sending out emails and stuff like this, right? So if you want to get onto this now, what you would be doing is you would be booking a mentoring program with Edward Sheck, basically 15 months up front, okay? So you'd be booking the Thailand program, and then for the 12 weeks after the 2 weeks in Thailand, you'll be doing a program with Edward Sheck. So you'll be speaking to Shecky every week. Shecky will have 10 places on this program. Then we'll bring in additional mentors later in this year, around April, May, okay? If you can't physically make it to Thailand, that's all fine. The next best thing is remote mentoring programs. We're accepting bookings for Q2 and Q3. So right now, if you're new to ITPM and you wanted to start in Q2, you can. You just need a couple of months to do your online programs, fund your trading account, jump on the phone with your chosen mentor, start your program, trade April, May, June. Okay. I don't do remote mentoring programs. I haven't done them since 2018. Shecky's not available for Q2 because he's on the Thailand program, and so is Jason. But Jason can take a couple of guys for remote programs in Q2. Just so you know who you're dealing with, I'm not going to go into too much detail. You probably wouldn't be here if you didn't know a fair bit about my background already. But I worked as a pro trader on pan-European equities trading desks in London at Goldman Sachs, Lehman, and JP Morgan, early to mid 2000s. Left the investment banking business as a trader, traveled the world, made a TV show, didn't really do much for 3 years except that TV show. And then off the back of the TV show, set up ITPM 2011, took it global in 2013, moved the company to Singapore, and myself physically to Singapore to get more tax efficient and live a better life. And then 2022, after COVID, emigrated to Phuket. 2023, set up more global infrastructure in the Cayman Islands. So I'm basically managing ITPM infrastructure, family office investments and trading outside of that in both Singapore and Cayman. Phil, this is his resume. I'm not going to cover that resume right now. Phil will do it later for sure. But let's get started. Let's get started on this topic, mastering compounding as a trader. So what is compounding? Well, it's making money on a regular basis and reinvesting the money on a regular basis. So you just make more and more and more and more and more. Okay. And compounding is not linear in the traditional sense. If you make a fixed amount every month, what happens? Well, at some point it just goes exponential. Okay. So here, what we did was, just so we can illustrate it, if you don't know what it looks like, we've looked at monthly compounding, just modeling $100,000 at 3% a month over 5 years, so 60 months. Okay. And you can see what happens once we start to go beyond 5 years, 60 months. The curve starts to go exponential. Okay. Now, the way to think about this, is just the variables that you're inputting into the formula, right? It's 100,000 at 3% over 60 periods, okay? In this case, 60 months, right? When you look at the modeling of compounding traditionally, it's usually year 6, 7 when everything goes exponential. What does this look like if we look at it on an annual basis? Okay, so we're looking at it as interest. We're making a $100,000 deposit into a box, into an account, bank account, trading account, whatever you want to call it, okay? And we're going to call it interest at 3%. What does it look like? Okay, well, at the beginning of year one, month 0, you're making $3,000, then 3,090, then 3,182, 3,278, 3,376. Beginning of year 2, you're at 4,200. Beginning of year 3, you're at 5,900 per month. 8,500 per month at the end of month 4. Sorry, at the end of year 4, and then month 48, beginning of year 5. Sorry, you're at 12,000. End of year 5, 17,000. Okay, so you can see you're just accumulating more and more dollars because you're reinvesting and compounding. Okay, so what does it mean? How much interest are you picking up in year 1? 42.5 grand. In year 2, 60, 86 in year 3, 123 in year 4, and in year 5, 176,000. So you're turning 100 grand at 3% a month into 589,000. Okay, so we're assuming 3% a month. The number never changes. It's linear returns, and it becomes exponential. And we're also assuming there's no additional deposits and there's no withdrawals from the account. Okay. Now, how does this relate to trading? Well, let's start with what we're not going to discuss today. Okay. First of all, there's a lot of confusion out there with retail traders between trading and investing. It's all about time horizon. Okay. We are not investors. We don't invest in companies. Okay. We trade the share prices of companies. We don't invest in companies. It's very, very different. So what we're not going to be talking about today is investing, where you buy something and then hold it for 3 years, 5 years, 10 years, and you never realize any profit whatsoever. It's just an open P&L, what we call a mark-to-market P&L, where you take the amount of shares that you have in the company and multiply by the difference of your in price and the current price of the stock. It's not real. Why? Because it's not realized. For the entire life of that period, of the entire life period of that investment, you could just have a massive drawdown in one day, 1 week, and then you're just down 90%. And everything that happened for, let's say, the previous 3 years where you were up was just theoretical. It's theoretical profit. Okay. And then it just reverses. And again, it's mark to market. It shows a loss, but you just held something for 3 years, 5 years, 10 years, and not realized any profit. That is the life of an investor, not a trader. Okay. We're not going to be talking about long only. So a long only strategy whereby you have a pension and you have 30 positions in your pension or 20 positions and you're long only. You're never short anything. You don't have any hedges. So when the market goes up, you think you're a genius. You make 15% in a year, 20%, 25% in your pension. That is mark to market as well, because it's investing. It's not real until you realize it. And then once every 7 years, you just get a massive drawdown. Again, it's mark to market, but you get the drawdown. That doesn't happen to traders. Traders are not investors, and we are not long only, guys. We're not investing in a pension, and we don't just buy stocks. Okay. Combined, what would that be? What would that be defined as? A buy and hold strategy. So if you've heard of this phrase, buy and hold, that's not what we do. Okay. Also, on the other end of the time horizon spectrum, we're not day traders either. Okay. That's for different reasons. It's because the odds are actually not in our favor to make money in the vast majority of cases. Okay. Can some day traders make money? Yeah. Does that mean it's a solution for retail traders? No. So if you have a 99% chance of losing on a strategy as a retail trader and a 1% chance of winning in one particular year, okay, does that mean it's a solution for traders? No, it's not. It means the odds are against you, okay? So can people actually make money from it? Yeah, some. Does it matter to us? No, couldn't give a shit, right? Because that one guy in 100 who makes money this year consistently will blow up next year or not make money next year, okay? So where are we? We are somewhere in between. We are 20 to 60 day long, short portfolio managers, predominantly trading options. So what we're going to talk about today is fundamental positioning, although we're not going to be focusing on it exclusively, the 20 to 60 day time horizon and volatility, long, short equity options portfolio management, putting the probabilities in your favor, having probabilistic payoffs, and most crucially, managing your trading business. Because it is a business. You have to approach trading as a business. Why? Your job is to make money every month. If you're not doing that, you're not doing your job. It is a job. It's a business. Okay. So if we look back and we look at investing, for example, are investors making money every month? No, it's not real because they're not trading out of any positions. They sit and watch the screen for 3 years and wait for something to happen. We're not investors. Returns, managing your business as a trader. If you want to get some, real insight into this, Phil has a video online. If you look halfway down that list, meet Gunter and Phil on the road to riches. This was filmed a couple of years ago. And we predicted the future on the road to riches. He's made 400%. And at the time he was up 58% in 5 months. Okay. So if you want to get a good idea of what we do at ITPM and how to master compounding, watch every one of those videos. You're going to see some common threads all the way through, and then it will make a lot more sense of what you're seeing today. Okay. And obviously, just as a side note, every guy that we put up there, if you add up their profits, we get to almost 1.3 million. Okay. So, does every guy do amazingly well at ITPM? Obviously not, but the majority do well. Okay. The majority do okay to well, right? And it's just that we can't interview every single person at ITPM. We have 1,500 traders globally, okay? So we can't literally be on webinars every day interviewing guys and then having the videos edited and then uploading them every week, right? It's just unworkable. So what these videos serve as is an example of how to do it, okay? Now, if you think about track record and what we call an equity curve, okay? What is an equity curve? It's the value of your capital in your trading account going up. When you lose money, it goes down. When you make money, it goes up, okay? What are we trying to achieve here? We want a left to right 45-degree equity curve. That's the ideal situation, what we would call the ideal line. Is it possible? No. You can never get the ideal line. Why? Because trading is lumpy, okay? You're going to get variation. When you draw a line of best fit through your equity curve, you want a 45-degree line, but there's going to be variation around that 45-degree line. Obviously, what you want to try and do is minimize that variation. You don't want to have wild swings around the 45-degree line, the theoretical 45-degree line, okay? You want to have it as tight as possible, as minimum variation as possible, but you should expect the volatility. It should exist, but it needs to be controlled, okay? And this is why, for example, and I'll look at this with you in a moment, we have statistics for people to understand their trading business and understand how to actually create a situation where the equity curve, they're managing their business so well that the equity curve goes up every month and they have minimal variation, as little as possible, okay? Let's have a look at some Institute Trader equity curves from the YouTube channel. So I did one with a guy, John, a webinar that we put on YouTube. You should definitely watch that, the most recent one. We filmed that in November and it went up in December. So it's very fresh. You can see it's obviously not a 45-degree line. Now, bear in mind that all these guys I'm going to show you now, we're looking at their equity curves over a short period of time. If they continue doing what they're doing over a long period of time, it's going to look a lot tighter with a lot less variation, right? So it's going to look less volatile. And you'll see this with Phil's soon. But it's going from left to right. It's going in the right direction. It's a nice situation. We've got Sean the Sheep from earlier in 2024. He did a mentoring program with Raj. So John up 58,000, Sean up 52%. I think John started with 100, just under 100 grand in his account, and Sean started, I think, with about 35 grand, something like this. So Sean obviously did very, very well. Both doing very well. I mean, to make $58,000 like Phil did, you know, over 12 weeks with 100 grand in your account is insane. Sean, the sharpshooter. Then we've got Phil and Gunter. So I've highlighted Phil there because he's going to be covering some of his stuff later. Dieter, who's also come on as a junior trading mentor as well. He made 100% in 6 months, and he's continued to make money. He's done very, very well. So we've brought him on, like Phil, as a junior trading mentor. Stefan, who was mentored by Sheki. Richard, who was mentored by Raj. Obviously, Richard's number is absolutely insane, up 850%. That was done over the COVID year, so 2020. So I believe he was trading from April, May 2020. And we captured, I think, we captured May till February. So May 2020 to February 2021. And he was just in like amazing situations for the most of that year, trading options. And he turned like $20,000 into $210,000. So he was up 850%. And his Sharpe ratio was something absolutely ridiculous, like 20 or something. It was absolutely insane. So yeah, these are the guys that, you know, if you look on YouTube on our channel, you'll see the common threads and patterns of what all of our traders do. And obviously you can learn how to do this properly with us. Let's talk about the business. So your equity curve is literally your business. Those equity curves we looked at, that is the business. You have to make it go up all the time. That's your job as a trader. Make the number at the bottom of the screen go higher. Does that mean it's mark to market? No. It means you're actually realizing profits on a regular basis, okay? But that's not 100% of the game. It's not just about making money. It's how you make your money. So that variance around the equity curve we're talking about, having this under control, you've got to control your outcomes, okay? So not just about making money, it's how you make your money, okay? So key annual stats that we look at, you're targeting trading options 50 to 100% return, but you can get way more than 100, as you've seen with other guys, okay? Phil is an example of that as well. Your win-loss rate, targeting 60-40, but we could like to see 65-35. You know, this year we've even got guys in the 70s, which is guys I've mentored this year in the 70s. Your dollar winners divided by your dollar losers, what is that? That's the amount of dollars that you make on your winners divided by the amount of dollars that you lose on your losers. The ratio, we call it the R score. We target a minimum of 1.5 over the long term. But really what we're trying to do is get in the high ones, possibly even with a 2 in front of it. If you're really good, you'll have a 2 in front of it, yeah? Your underlying portfolio volatility. What does that mean? 20 to 30%. It's annualized portfolio vol for the underlying portfolio. So if you, for example, have a whole bunch of call options and a whole bunch of put options every day throughout the year, what would it look like if you replaced all the calls and puts with long stock and short stock positions, and then you tracked the volatility of that portfolio for the last year? The underlying volatility of the portfolio is going to be somewhere between 20 and 30%, depending on market conditions. What does that mean if you're trading options? Well, on average, you're probably going to be multiplying that number by 3 to 4, because options give you leverage. And on average, options in a portfolio, the way we do things, will leverage up the 20 to 30% by 3 to 4 times. Okay, that's the average. Does that mean you're going to make that all the time? No, because you can make a lot more. We're targeting the 50 to 100%, but you can make a lot more because we're trading options. Okay, so 20% underlying portfolio vol, you should be landing 60 to 80, something like this. 30%, you should be landing 90 to 120, something like this. Okay, because there's more volatility in the market. You're trading options, so your outcomes should be better. Like, we're long volatility options traders. That's what we are, but we're trading in portfolios. Okay. Average days in a trade, what's going to happen over a period of time? We're trading in the 20 to 60 day time horizon. Some of them are going to be quick trades where you're in and out within 5, 7, 9 days. A lot of them are going to be 30 days, 40 days, 50 days, 60 days. The average is probably likely to be 20 to 25 days, but you can obviously have some acceptable variation around that. It also depends on the underlying volatility in the market. Okay. But reminder here, guys, we're going to be talking about the business side of things here today. Talking about the business side, we're focusing on the returns. We're focusing on the money. Okay. I want to remind you, the returns are the outcome of implementing the process. You do not get the returns at all unless you focus on the process, not the returns. If you focus on the returns and not the process, the returns will never come. So what we have at ITPM in terms of the professional trader process, that's what you have to learn first. I've got to remind you of that because people get obsessed with the returns and completely forget that the most important thing is the process. Get the process right and the returns will follow. Okay. So compounding as a trader, mastering it. Remember, your equity curve is your business. You are in the business of increasing your equity. How is it done? Well, just think about it. Like, every month, if you're entering and exiting trades, what's going to happen? You're going to create on the equity curve the next node. So you book a bunch of winners, you book a bunch of losers. What happens? Boom. You've created a node. Do you want the next node to go down? No. You want the next node to go up. So you're in charge. If you book 10 grand of winners and 15 grand of losers, the node is down. It's negative. It's -5. If you book 15 grand of winners and 10 grand of losers, the next node is up. You've just created the equity curve going up. Okay. You're in charge. You create the next node on the equity curve. So you are in charge of your business and the outcomes of your business. And obviously, you don't increase your equity curve, the equity in your account, by just sitting there and doing nothing and watching everything. Okay. Because in that situation, you only have a mark-to-market P&L. That's basically an investor. You're sitting and watching, and it's theoretical. It's not real. Okay. You've got to realize the gains and create the next node on the equity curve. So what does it look like? Let's go back to our compounding. So we looked at this table earlier, the compounding table. Year one, 3 grand at the beginning, 4 grand beginning of year 2, 6 grand a month beginning of year 3, 8.5 grand beginning of year 4, 12 grand beginning of year 5, and then at the end of year 5, beginning of year 6, you're basically making 17 grand a month. That's $100,000 deposited at 3% compounding. Okay. So year one, what are you trying to do in trading? You're trying to book a net minimum, an absolute minimum. Okay. Net 3,000 to 4,000 a month. What are you trying to do in year two? You're trying to book an absolute minimum 4,000 to 6,000 range. Year three, 6,000 to 9,000 range. Year four, 9,000 to 12,000 range. 12,000 to 17,000 range year five. Okay, so let's look at an example. Very simple. Year one in June, let's call it month 6 in year one. Okay, you know what your target is. You need to book somewhere between $3,000 and $4,000. So you decide that month you're going to exit some winners and book $7,500 and exit some losers and book $3,500 of losers. So you book a net $4,000. What does that mean? You have an R score, a ratio of your dollar winners over your dollar losers of 2.14. Okay, but you're booking a $4,000 profit that month. You've just made the equity curve go up. Okay, that's a choice. Now, that's the end result. Okay, what have you got to do to actually get that, to be in that position? Okay, well, if you create this situation where whatever you put into that bucket, you've just got the ability to make the range every month, the minimum, the absolute minimum. Okay, what do you have to put in that bucket to make more? So let's say your trade structuring and your risk management is so good that whatever you put in that bucket, you just make the minimum. Okay, every month you just make the minimum. What's going to make more than that? Well, if you just put good trade ideas into that bucket, you're going to make more than that per month. Okay, so with that, we're now going to show you an actual proper example. You've seen the theory of how it should work. I've shown you what compounding looks like in theory, okay, and how it would apply to trading in theory. I'm going to hand it over to Phil now, and he's going to show you what it looks like actually in practice. Take it away, Phil.
Thanks, Anton. So let me share my screen real quick. So you should be able to see it now, right? Anton, do you see it?
Yeah, we see it, but you got to maximize and then press the hide button. Yeah.
Okay.
There we go.
Perfect. So before I start, I want to give you a short introduction of myself. So I graduated college in Vienna, so I did study project management and IT, and I also graduated various ITPM courses, the IPLT, PTM, and POTM. So yeah, and I also did a Thailand mentoring program in 2022 in April, and Anton mentored me afterwards. So 3 months after April, I was on weekly calls with Anton, and he taught me all the stuff I need to know. I work in the public sector in Austria in the aviation industry. I'm responsible for the project management office there, in the strategy department, and yeah, overseeing the strategic project portfolio, yeah, doing strategy work and so on. And since last year, I joined ITPM as a junior trading mentor. So yeah, proud to be part of the team. So I want to show you the proof of my portfolio. So I want to show you the screenshot from my actual broker. I trade with TradeStation. It's a broker recommended by ITPM. You see here a screenshot from March 2022. In the bottom, you see my starting account balance. So the cash I had in the account was around 13K at this time. You see I deposited around 85K into my portfolio as well in March, and I had around $4.5 thousand dollars in actual positions, because prior to the Thailand mentoring, I also traded by myself, because yeah, I completed the first course in 2019, the PTM, and then I traded on my own a few years before deciding to do the Thailand mentoring. On the next page, you see a screenshot dated on the end of 2024, so December 21st, 2024, and I will run you through my numbers. So on the bottom, you see total cash balance about 143.5 K. I had a market value, this is the open positions I had at this time, about 226,000, and I withdrew around 140,000 in 2024. I will show you the screenshot on the next page about the withdrawal, and you see on the bottom, this is an account balance or account value of around $509,733. So on this page, you see my withdrawals. I withdrew around 140,000 in 2024 because half of this is going to the Austrian government because I have to pay a shit ton of taxes here, capital gains. So 70K is for the government and another 70K is for a deposit on a new apartment. So this leaves me with, if you take the number of $509,000, so this was the account balance end of year. And if you subtract my starting account balance, this leaves you with a total profit of $407,000 since I started trading, or since the Thailand mentoring. So basically since May 2022. Okay. So before we jump into the spreadsheet and I show you some actual trades of mine, I wanted to just tell you what you will learn on the mentoring. So I record my stats like every mentee does at ITPM. So we have some spreadsheets where we download the history of our trades, and from the broker platform, we dump it in the spreadsheet. We also have the options monitor. So this is my active portfolio where I do all my risk management and where I put on new positions and see, okay, where do I need new trades for my portfolio in which sectors. And this can all be learned at ITPM. So if you decide to do mentoring like I did, you will learn all this stuff. You see here, and after this slide, I will jump right into the spreadsheet. You see here my equity realized curve on the right side. So realized equity curve is all the realized P&L. So every trade I did is summed up in this equity curve. And as Anton said, perfect would be like a 45-degree line from bottom left to the top right, but there are some variations. And as you can see here, there are some variations over 400 trades, but the direction is right. I'm quite happy with the results, but there is always room for improvements. So I will try to improve this as well. So let's jump right into the spreadsheet. You should now see my spreadsheet here. So on the left side, this is the TradeStation data dump. I don't want to go that much into details. I just wanted to show you when we go down here the withdrawals I took. So for example, here on as we've seen on the screenshot, on the 2nd of December, I withdrew around 100K from the portfolio. So my account balance reduced. So this is just the data dump from TradeStation. What is far more interesting, I think, is the equity curve. So let's zoom in a little bit. You can see it better. And what we see here on the bottom, you see the number of trades I did. So overall, around 400, let's call it 400 in the last 32 months. And you see that in the beginning, it went up quite nicely. Then there was the end of the mentoring, where it basically went down and went sideways a little bit. So some variation in here, but I pushed through it. I developed trade ideas. I traded. I said, okay, let's push it. I know I can do this. And after some sideways trading, it really started to click in again, and I was able to make to nearly make or push the equity realized curve to 200,000 here at about trade 240. Yeah, it went up a little bit, then it went down a little bit, and it went back up again sideways, and then the last year was really good for me. I made over 100% in profit, and you can see here where it really started to accelerate and went up as high as $437,000, and right now I'm at the 407,000 mark. So yeah, basically that's not right, because yesterday was the January expiry, and I was able to book another 24,000 on January expiry. So yeah, this year starts quite well for me. So yeah, let's see how I can improve that as well. Okay, so if we go to the realize tab, this is where I note I write on every trade I did. I want to show you some stats on the top, and then I will go through some trades. So my stats are: I won nearly $2 million over the last 32 months. I lost about $1.5 million. So my total profit was around 425,000. I paid a commissions of 18K. So this leaves me with a net of $407,000. My starting equity was about 102,000. Equity now 509,000. So including commissions, I made around 400% since the Thailand mentoring program. On the top right, you see some stats that I'm not that proud of. I want to improve them. My win-loss ratio, you see wins 52.5%, loss 47.4%. So this is definitely something I need to improve, as well as my R score. It is at 1.28 over the last 3 years. I want to push it to the at least 1.5 mark. I have to say last year, so in 2024, it was at around 1.31. So it's improving every year. So yeah, hopefully in 1 or 2 years, it will be at least at 1.5. And right below, you see average days in trade. So I'm on average, I'm 34%, 34 days in a trade. So this fits very well with the 20 to 60 days time horizon, which is taught at ITPM. Okay, let me just make this here a little bit bigger. Yeah, before I show you some of my trades, on the right side, you see my cumulative P&L minus commissions. And if we go all the way down, you see here right now, end of December 2024, it was at $407,042. Okay, so let's go through some of my trades, and I will also try to link them to the topic of today's webinar. So topic is compounding, and one way of compounding is by collecting credits. So this is when you initiate an option structure where you buy, for example, a call option, but you also sell a call option on the other side. So you're not only buying a long call option, but you're selling something. So this is adding value to your portfolio. And one trade that I did was on holdings. So you can see here, it's marked in green. You see on the bottom on holding, long call. So it's an October expiry. I bought the strike 42.5, and I bought 64 contracts. I paid $2.97, and I initiated it on 26th of July. On the other side, I sold something in August. So this is a calendar spread where I bought the October and I've sold the August call options. And here I sold the 43 strike, 32 contracts. So this is a ratio of 2 to 1. So we have 64 contracts to 32 contracts. I sold them for $1.39 and I was able to buy them back at 20 cents. So what you can see here is on the 13th of August, so after only 18 trading days, I was able to buy back my short leg for 85% of the possible 100% credit. So I collected $3,800. The maximum would have been around $4,400. And after I've collected the credit, the position, so on holding, the underlying stock went into my direction. So the stock went up and I was then able to book another $30,000 on the 20th of September. So this is where this is like the perfect scenario for a calendar spread where you are able to book the short leg before the long leg really goes into your favor and you book profit on both legs. So this was a really good trade. So instead of only booking the 30 grand, I added value to my portfolio with the short leg and added another 3,800. There are examples where it's not going into your favor, and I've highlighted Snowflake. So this is a put structure. So basically I went short Snowflake, and this is an October-September calendar spread. With put structures, you want to sell, you want to buy a higher strike than you sell. So in this scenario, I bought the 110s, I've sold the 108s. I bought 30 contracts, I've sold 15 contracts. So this is the 2 to 1 ratio. And the long leg, I was able to buy at $6.22. And the short leg, I was able to sell for $2.55. On the 10th of September, I initiated the trade. So basically, I initiated the trade here on the 7th of August, and I bought the short leg a little later on the 10th of September. So what you can see here, after only 6 days, I was able to book the credit. So I booked like 75% of the credit, which was around $2,900. The maximum would have been something about $3.5, $3.7 thousand dollars. So I booked 75% of the credit, but then the position went against me. So this is a put structure, which means Snowflake went up in price, and I've lost. It was a full write-off. I lost everything on the long leg, so minus $18,669. But because I had a short leg up here, my actual loss decreased to minus 15,779. So this is where the short leg, the credit, also added value to my portfolio because it reduced the overall loss I was making with the structure. If you only buy long puts and long calls, you don't have the possibility to collect credits and to compound or to add value to your portfolio. Yeah, another good one. This was another structure, so it's not a calendar spread, but a vertical spread where you buy and sell the same expiration. And you also have the same ratio. So 11 contracts on the long, 11 contracts on the short. So this is a call structure. I bought the 190 strike for Coinbase, and I've sold the 260 strike for Coinbase, both expiring in December. So this was a Trump trade idea. We all know Trump is pro crypto and stuff. So I thought, okay, let's try to make some money on this one. It worked quite well because you can see here on the long leg, I bought them for $17.70, and the short leg I've sold for $4.50. And as you can see on the right side, I was able to sell my long leg for $128.59, and the short leg I bought back for $70. So although the short leg lost like 72,000 on the structure, my long made nearly 122,000. So overall, I made like 50,000 on this structure alone on this one trade. Yeah, and that's, by the way, more than most of the most people ever have made in crypto. So yeah, I don't think there are a lot of people who made like 50K with Bitcoin or so. So I made this with one trade on Coinbase in 50 days. You can see here, I made like 50 grand with this trade. And you may ask, okay, why is it a good thing that because the short leg lost like $72,000, but because I initiated the trade like this, I kept my maximum profit at 260. So if the underlying price is at $260, I kept my max. This is where my maximum profit is kept. But when I initiated the trade, I was very happy. This was a 4.5 risk reward. That's more than the usual 3 risk reward. So I was very happy to put it on. And I'm very agnostic because if the trade is not going in my favor, because I have the short leg on, it will lower the loss, the maximum loss of my trade. And this is why I put on the Boeing example here, because I wanted to show you how this works. You can see here, this is a long put, short put. So I'm a put structure. I was short Boeing. I bought the 140 strike. I've sold the 125 strike in a 1-to-1 ratio, so 39 contracts each. I bought the long for $5.13. I sold the short for $1.48, and I was able to. So the trade didn't go in my favor, so it was nearly a full loss of 90%. But because I had the short leg on, my net loss reduced from 18,000, and if I add this, it reduced to 12,380. So this is where the short leg adds value to your portfolio, because I was able to reduce my my loss from 18 to 12K basically. And what I wanted to show you is when I filter for all the short legs. So this is all short puts and short calls I've put on, and I filter for the ones where I booked something. You can see here when I mark this column, you can see here this column. You can see on the bottom, I don't know if you can read it, but it says $254,000 I collected as credits. And why did I only filter for the ones that made profit? Because when the short leg is losing money, your overall structure is making money. Like in the Coinbase example, the short leg was losing a lot of money, but the long leg was making a lot of money because we sell them, or we buy and sell them in a ratio of 2-to-1. So this is where the short leg or collecting credits and selling something against your long leg is really adding value to your portfolio. And I've dumped this into another spreadsheet, which you can see here. So if I go all the way to the bottom, you can see here the $254,000 I made with the credits. And if we go back up, you can see the equity curve contribution. So this is only the short legs of where I collected a credit. You can see this is a beautiful line from the bottom left to the top right. This line doesn't have a lot of variation, so it's adding stability on a monthly basis to my portfolio, because I'm continuously gaining some gaining some profits on my short legs. Yeah, so this is really what Anton has shown us in theory. Yeah, hopefully shown you now in practice. Yeah, and let's jump back to the presentation because I have some other statistics as well for you. So this is just a reminder of my stats. Yeah, I don't want to go that much into detail. I definitely need to work on my R score and on my win-loss ratio, but I have to say I'm really happy with my results. So yeah, if the R score improves, that's fine. If not, I'm really happy to make 100% a year with my R score. Here, this is the slide I wanted to show you. Over the last 32 months, I was able to collect $254,000 in credits over 102 trades. My average credit size is around $2,500. So yeah, the percentage of the credit, we aim for like 10 to 20% of the long leg. So the percentage stays the same, but obviously as your portfolio size increases, the dollar amount will increase as well. So in the beginning, my credits were maybe around $1,500, and now they're about $3,000 or $4,000. So per month, on average, over the 32 months, I was able to collect nearly $8,000 in credits. Yeah, so this is really where selling something against your long leg, either your long put or long call structure, makes a lot of sense, adds value to your portfolio because you are able to compound credits every month, month over month over month. And yeah, you can see on the left side the credit equity curve, which is a straight line and has not a lot of variation. It's stable. I collect credits every month. And on the right side, you see my total equity realized, which is the credits plus my trading profits. There is some variation in it, but the direction is totally fine. Yeah, and I don't know how much more proof you need that this is the right way to do it. Then the theory from Anton, and now the practical example from myself. Okay, Anton, over to you.
Fantastic. Cheers, Phil. So you need to unshare, and then
Yep.
I'll step in.
Yep. Okay.
Okay, let me share the screen again here. You guys should be able to see this. Everyone can see that, right?
Yes, I can see it.
Yeah. So I'll just pick it up off the the last slide you were discussing there. So Phil showed you some examples there of why compounding is important to a trader, and you can see over the last couple of years how it's really anchored and motored Phil's performance, right? Because if you look at on the right hand side here first, and you look at his total equity curve, that obviously includes credits and everything outside credits as well. Okay. So what does that mean? Well, if you look at the performance here, it's like during his mentoring program and for a little bit of time after, and then he's making money. Then afterwards, he's struggling a little bit. Okay. Then he's going up again. He's struggling a little bit here. Things are going sideways in two portions of his equity curve for a good few months, right? And then it takes off again. Okay. Now, what does this do? If you look back on the left here, if you think about making a minimum amount of credits every month, so this is the equity curve of only the credits, not credits plus everything else. If you look at credits in isolation, it's like the ideal line because as a percentage of his account, he's booking credits every month in a linear way. Okay, so as the account gets bigger, the percentage stays the same and the credits just get bigger, right? And he's booking them every single month. What does it look like? It's basically almost a 45-degree line. This is the anchor that underpins the performance. And then what is outside of that? Everything else is your ideas and your trading ability. And what you're doing is you're taking your ideas and saying, okay, I'm going to buy call options, I'm going to buy put options, but I'm going to sell something against it, a probabilistic credit. Okay. And what happens over time, over many, many months, the credits build up and build up and build up and build up. And because you have this protection, what happens here? In periods where you're struggling, you're going sideways, your credits are saving you. So your downside is protected. And when you're going up, your credits are adding on top of your trading, right? So it's asymmetric returns. If you're getting credits every month like this, if you learn how to do this at ITPM, and then you add good ideas on top of it, what's going to happen? You'll have great periods where you're going up a lot, like Phil, okay? And you'll have periods where your ideas are not so hot and you go sideways. But why do you go sideways? Because you know how to do this. And your credits every month save you from losing money, okay? It's asymmetric returns, guys. So this is what you got to learn how to do. You've got to learn how to trade options properly as a directional 20 to 60 day volatility time horizon trader, long short. So long short meaning you call the direction upwards and downwards for stocks, and you always have call options and put options at the same time across different ideas. So you have long ideas and you have short ideas. They're represented by call options and put options. And you have to learn how to turn those ideas into a credit machine where you're making credits every month. So you have your credits P&L and you have your trading P&L, and together they create your equity curve, okay? And obviously, very, very important part of learning the credit side of things is structuring, option structuring. So learning how to do like the calendar ratio spreads that you saw Phil talking about, the vertical spreads that you saw him talking about, and also managing your outcomes every month. So you have to learn how to manage the risk of your portfolio, where every month you have a monthly options expiry. You have to learn how to make the equity curve go up every month. How is that done? By managing the risk of the account, okay? And therefore you control your outcomes, right? So obviously it's a skill that is teachable, it's learnable. Plenty of people do it at ITPM. Hundreds and hundreds of people do it at ITPM. Can you guys do it? You absolutely can. But it's not easy. You know, you have to put in the effort, okay? You can see Phil, he did a mentoring program. He flew over to Thailand. He put in the effort. He invested in himself. He put the money in his trading account and he did the work. This doesn't fall from the sky or out of a tree. You don't just show up at ITPM, watch a few videos, and then open a trading account, and then the money just starts landing in your account. You actually have to do the work. You need to put in consistent input to get the consistent output, okay? Phil is working every month doing this outside of his main job, okay? We've brought him in as a junior trading mentor now because he knows how to do this process with his eyes closed. He's really good at it. You can see he's really good at it, okay? Now, remember, this is trading, not investing. You've got to be active. You know, you have to make realized profits on a regular basis, okay? But don't focus on the returns, okay? We're giving you an example today of how it's done, what it looks like in theory and what it looks like in practice, okay? You need to learn the systematic process first. The profit comes later, okay? Never forget your job. Your job as a trader is to make money in all market conditions. whether the market goes up or down, from the 20 to 60-day directional volatility. You got to be trading constantly, not every minute, not every hour, not every day, but a couple of times a week. You're going to be logging into your account and actually trading, okay? Most important, most of your time is going to be spent outside of the trading account, believe it or not, because you're going to be generating ideas and managing the risk of the account so you know the actions to take to book a net gain every month. That, at the end of the day, is what makes your equity curve go up, okay? Professional traders, we have got a systematic process, okay, that we've learned at the beginning of our careers, and we implement it constantly. Part of that process is managing risk significantly better than retail traders could even imagine, okay? If you want to learn how to do things properly in the same way as the way we do things, the way professional traders do things, it is a big commitment, guys. But it's like nothing else you've seen before. I can guarantee it. All the stuff you see on YouTube, on Reddit, on all these on social media, Instagram, Facebook, Twitter, whatever, right? To us, it's laughable. It's a joke, okay? No, Phil, before he came into ITPM, was like a lot of you guys, interacting and engaging with a lot of this stuff. I can't tell you the amount of people who come into ITPM who are like that before they come to ITPM, dealing with all of that nonsense, right? And then after 6-12 months of being at ITPM, they cannot believe how different it is. It's completely different to anything you've ever seen, okay? So guys, that's me. We can do Q&A for as long as it takes, usually half an hour, 45 minutes. So if you've got questions, please stick them in the Q&A area. Phil, why don't you answer a few of these questions?